Damien, we had Jeff Curry on. He intimated you could see 90. At what point do you want to re-rate your base case to something like 90?
So our base case is actually now $90 for the end of this year for Brent. What we've seen just the last couple months point to a market entrenched in a large deficit. The Delta wave was a smaller hit to oil demand, and now the gas situation is actually creating upside risk to oil demand, and Iran negotiations are not going anywhere. So we are heading for a period of low inventories. You mentioned price at their highest in 7 years. Well, inventories are about to fall to their lowest in 10 years. And in our view, that requires another leg higher. So, the OPEC meeting just completed, and for us, very much sets the stage for another meaningful leg higher here.
When is OPEC going to come under pressure from Washington, D.C. to do more? Gas prices are rising, and I'm talking about at the forecourt. The U.S. consumer is going to feel that fairly quickly.
So, the White House apparently was in contact, but didn't stress for OPEC to ramp up output at this meeting. There are maybe a couple of reasons for that. First of all, the acute shortage today is in gas, natural gas, not gasoline. So that's probably the most pressing issue. Second, adjusted for the overall level of income, gasoline prices are not as expensive as they were over the past decade at times. And third, OPEC is gradually ramping up. I think the pressure probably to do more will intensify if our forecasts prove right and oil prices are trading at $90 and with upside risk. So, I think that's something that could still play out. But as you think about the market for the next 6 months, this deficit, which is already the longest on record in the oil market, will persist. And even if OPEC did a lot more, that's at the mercy of its spare capacity. So this is just an outright bullish outcome. We just need more investment in oil production here.
So before we get to the supply response, just one more on the demand. Saudi Aramco in that OPEC meeting said that the spike in gas prices has increased demand for oil by about 500,000 barrels of oil a day. That's a lot of gas to oil switching. It's not that easy in every refiner, et cetera, or every pipeline. What has your models noticed in terms of what that switching actually is?
Our estimate actually isn't far. We're at 650,000 barrels per day. Now, keep in mind, right, we have a high stock of power plants that could run off oil. That was one of the incumbent fuels just 20 years ago. So that switching can happen, and we see it every winter. Towards the end of winter, when you're running out of gas, you will see those spikes in oil burn. So, are we seeing it now? Yeah, if you look at, Pakistan, Bangladesh, even Singapore fuel oil inventories, that's definitely pointing to substitution. Europe has less ability to do so, but on a global basis, we could easily do at times maybe 1 to even 2 million barrels per day during a very cold wave. The one main issue for the gas market, that's not sustainable. What do I mean by that? Those power plants are peakers. They ramp up for a few days and cut it off again. And so that won't allow oil to really solve the gas shortage, although from an oil market perspective, it suddenly becomes an upside risk to demand.
Damien, you talk about Europe not having the ability to make that switch so easily. At the moment, there's scarcity in Europe, prices are high. What about actual shortages? Is that where we're heading? How cold does it need to get for that to happen?
It's a real risk, right? Keep in mind, we're in October. Winter hasn't started, and we have the lowest level of gas inventories. And so when you run normal weather distribution, you end up with decent share of outcomes where you truly hit shortages by February, March. So that's what the market is solving for. Again, no blackouts needed now, but you still have to resolve this underinvestment and lack of supply. So what's happening? Well, we mentioned gas to oil substitution. We're through that price threshold. The second step now is you're pushing some industries in Europe, manufacturing, fertilizers, at the margin on a global competitiveness perspective, which would reduce their consumption of gas. That's where prices are. Now, if it's a mild winter, we're okay. But again, you take a 1 standard deviation colder winter, and we truly have a problem. So nothing is resolved yet for Europe. And I think that's the key to keep in mind here.
So when you talk about your base case being 90 now, what is your upside risk? Are we talking 100? Are we talking over?
So keep in mind, in oil, unlike gas, we still have that spare capacity. Now, the real bullish outcome for any commodity market is your short-term shortages, right? If you don't have the supply, as we're seeing in China now, you have to destroy demand. That's blackouts. And oil, we're not there yet, right? And again, I think of the energy complex, it's the lagger, but we're getting closer. And it's easy to envision, whether it's diesel, for example, fuel oil, where you're really boosting demand now to have those shortages. And then, yes, 100 is conceivable, above $100 conceivable. OPEC does respond, right? They don't want this economic shortage from an oil perspective, reducing economic growth. But, as we just learned today, it's not going to be immediate. And even when they decide, it's at least a month to play out. So I think that's the real risk that we see. Again, gas much more explosive. We're at that critical juncture. Oil could head there.
Damien, I've heard energy CEO, and I'm talking about the shale patch here, after energy CEO, telling me that they are going to be disciplined. They're not going to bring extra capacity back on. They're here for the shareholders. They're not here to pump more and more and more. At 90, at 100, at 110, how disciplined do you think they're going to be?
That's a key question, and that's actually what we solve for, right? When we argue oil prices have to be higher, it's because we need that investment to come back. Now, we've tested $70 for 6 months, and clearly that's not sufficient. The activity of public producers, the one that really matter, really hasn't picked up much. So we think that's an 80-85 range that finally gets them to ramp up. But at the end of the day, they're no longer solving for an oil volume and an oil price. They're increasingly solving for their share price. So as long as E&P stock prices are not materially participating to this energy rally, they are not getting the signal to ramp up. So that's probably what to look for instead of the oil price alone, is really how investors are willing to see producers ramp up. And I would say today we don't have that signal at all. Now, what will compound the bullish nature of the energy crisis is really the cost inflation, right? When those shale producers come back to ramp up, well, service companies will be fewer and will have a lot more pricing power. So what could be critical to shale is really that step higher in costs in coming years.